getting harder and harder to get in property in the next 6 years. I reckon we're going to get into more headwinds. How could it go wrong? It did, but it nearly sent Dad bankrupt. That was a tough pill to swallow. When you've got a pretty humble family, then it's gone miserably wrong.
You took the leap while still at university. What that was?
I convinced my dad that it's a great idea to double down in a townhouse development in a regional location. And on paper, it all looks 30-40% profit margin on that. But once you start something that big, there's no way out. And it took 7 years, Reece, to get back to square one. And I was training full-time, essentially trying to be a professional footballer. And then I was delivering mail around university. And I was steam cleaning carpets for people's homes because I just wanted to repay the favour because I knew crippling them financially.
A lot of people will think property landlords with multiple properties, they've had it handed to them. What was the strategy to get out of that direction?
I had to learn the true value of property and what drives value. But my job is to try and outperform the market through the years of experience and the data, and that's our obligation. 6 years later, we've outperformed the Australian property market almost 3%. If you can own your home debt-free, after that, everything else is a bonus. And that's what I'm passionate about.
You're listening to the Follio Property Podcast. I'm Reece Bedell. Joined each week by my co-host Lachlan Delahunty. Lachlan, this is a special episode, one you've been a bit reluctant to do, but I've had the podcast running 12 months now under initially a different alias, but in terms of podcasting, we've had it 12 months, so we thought it'd be good to get the Lachlan Delahunty story.
Yeah, Reece, you twist my arm to do this, but here we are. Let's, at your request, we can go through a bit of a journey.
Excellent. All right. Take us back, Lachlan. Murtoa, 600 people. One kid in your year level. How does that shape your mindset?
People don't even know where Murtoa is. So Murtoa is a country town halfway between Melbourne and Adelaide, population 600 people. Very small remote town built on pretty much two things, farming and football, and the local pub. That's pretty much it. So there's not a lot there, but full of lots of love, lots of family is still there. And like you said, I grew up with 13 people in my primary school, of which Jack was the only one in my year level for all of primary school, me and Jack.
Hey guys, quick thing to share. If you're serious about investing in Australian property right now, you need to see what we put together. It's called the National Investment Report, and it's our brand new monthly deep dive into exactly where the market is moving, what the data is saying, and what the smart investors are looking at right now. The March edition has just dropped, and you can get the first access completely free. Just scan the QR code on the screen right now or click in the link below to fill out the form. So for someone who's very sociable, that must have been a bit of a challenge then to meet people if you've only got 13 people in your school.
I was related to 4 of them, so it sort of, it starts to paint a pretty sheltered upbringing, but it was quite the opposite, Reece. When you grow up with not a lot, and these days everything's in abundance, whether it's friends or social media or everything else, when you grow up with nothing, no technology, not a lot of friends, just Jack and I, right? And not a lot to do, sort of go create your own fun. I think it's an upbringing that many would envy. We just had so much fun. You make your own fun and you learn so much more because you're out there doing productive stuff and the things that you wouldn't do these days.
Talk us through the upbringing from your family side. You've mentioned on the podcast previously about your dad being a builder. I think your mum's a nurse as well. Is that where the property interest came from? Yeah,
so growing up, school holidays in Murtoa, there isn't a heap to do, right? So and you don't have daycare, so it was go to work with Dad every day and pretty much slave labour for the old man. But you pick up things, right? So David's just a local builder in the area, mostly doing old character home renovations. Everything there is built sort of 100 years ago when they were putting down the railway, so they're all homes that have a heap of problems. So naturally, just around property all the time, and like anywhere, particularly in Murtoa, it's no different. People take a lot of pride in their homes, and their home is their castle, and it's probably more relevant there than anywhere I've ever seen because it is a very social place, although very small. It's come around for a barbecue, come around watch the footy, come around for a beer, and how you use the property and how people took so much pride in doing a renovation, inviting people around. It's on display for the whole town, right? So when you don't have a lot, that home becomes everything, and Dad was a big part of many people's lives in the area because he was able to turn what was an old rundown derelict home into something that was beautiful. And being a part of that journey as a young kid, it was, at the time, didn't think much of it because Dad would just have me running around picking up bricks and throwing them in the bin. But just being around that was, now in hindsight, a pretty beautiful time to learn, I guess, small fundamentals of property, right?
Well, having seen some of the properties you've had or previously had in your portfolio, you do love a character home. a value add as well. So I'm assuming that's probably where you've got the passion from.
Must have picked it up. But yeah, I love keeping heritage in homes, right? There's only a finite amount of homes that have been around longer than 100 years, and every year they continue to bulldoze them. So I do have a passion of trying to restore the young history that we have.
Now, I'm assuming at that young age, you weren't thinking of starting a property investment company. What was the passion at a younger age, and what did you kind of think you were going to be when you grew up?
Sort of two things. You either get in trouble or you play footy, right? So that was all I did. You obsess about football. Football is like the community in the town. It's what drives that whole district, the whole area. It's your family is the football club, and Dad was a household name for many people in the area. Won plenty of best and fairest for the Murtoa Footy Club, the Murtoa Magpies, and just growing up around that was all their dreams and ambition were all around football. And for me, it was a vehicle not just to pursue football, but actually to become really important for my education.
Brothers, sisters?
Yeah, older brother, older sister. Big thing about mum and dad, they never had tertiary education, and all they wanted for their kids was to do everything they can to give their kids the opportunity to go to university, right? And even though I was always trying to push a footy career, the most important thing was to give us the opportunity, not force it, but give us the opportunity. And when you're in Murtoa, that's a big stretch for modern people these days. Be like, going to uni's just a walk-up start, but in Murtoa, really difficult, not only by proximity, 4 hours away, but financially, and the idea that you're going to go to university. And when you're growing up in the 90s, it was as far as you could possibly reach. You didn't know too many people that actually aspired to go to university. So it was a massive achievement. They achieved it. Put one through med school, another one did construction, and I went through and did property degree. So hats off from mum and dad. They achieved their goals. Talk
us through that. So what moment did you go down the property angle in terms of university? Like, was that from a qualification perspective, was that always where you were going?
Not always. Obviously, I always had a passion for it. So to get onto the next phase was football became something that I became more, I guess, involved in. You sort of go through the programs, and that enabled me to go to boarding school. It was there that I realised that I was a long way behind academically, and Dad was although super passionate football, was always pretty grounded that education's got to come first. So I remember we got a scholarship. Mum and Dad had paid a lot of money for me to go to boarding school, and I was never going to waste that. I spent 4 hours studying every night, every recess. Everyone was out kicking the footy and playing cricket. I was in my room studying because I just wanted to repay the favour, because I knew how much it was crippling them financially. Like, didn't have anything, and yet they're paying for me to go to school. I couldn't abuse that, which gave me the ability to get a score that enabled me to get into Deakin University to study property and specialise in valuations. And that was predominantly off a book that I was reading at the time, 0 to 130 Properties by Steve McKnight. Certainly wouldn't advise people to take the advice that he did, but that was something I was reading in year 11 that got me excited about property, and seeing this particular investor took a strong position in country regional towns. And I knew, that's all I knew. I'd really been out of Murtoa, right? So it started to make sense. I thought that's pretty interesting. What am I going to do post-school? Probably become the next to-do thing.
University, you mentioned this on the podcast, several episodes regarding you took the leap and started acquiring your first property while still at university. Talk us through what that was and where that sort of purchase went.
Yeah, right, Reece, you're at university, your second year in your degree, you've done a couple of essays and you think you're the absolute expert at property investment. And being relatively good at the sales side, I convinced my dad that it's a great idea to double down. I've done a lot of feasibilities. I think we should start doing developing. He's the builder. I'm clearly a fantastic, astute investor, know everything about property, and I'm second year in university. So we did something that I'd tell any client or any investor not to do, and that was buy in a small regional area. The town was Horsham, so 20,000 population, that's built predominantly on one economic driver, which is farming. So very volatile to droughts and so forth. So again, not an area that you should be investing. And participate in a development, a 6-house townhouse development in a regional location. And on paper, it all looks great, right? And sales, it's going to be 30-40% in this development. Dad's a builder, so there's going to be profit margin on that. How could it go wrong? Well, as you can imagine, how could it actually go right? And true to form, it almost, not sure how close, It did, but it nearly sent Dad bankrupt. So it was a tough pill to swallow, particularly when you're earning pretty much no money at university, right? Trying everything you can, and you've got a pretty humble family that have taken a leap of faith, and it's gone miserably wrong. It was definitely a testing time for me.
How did you navigate that? I'm assuming, it's not just probably affecting yourself, it's affecting your parents and maybe even your siblings with
well, my sister bought one, I was in for one, Dad was in for the rest. One thing I learned, like they always say, never mix your personal life with your professional life, business for pleasure, and I absolutely echo that, just because it become really testing relationship, because you're wanting updates, Dad, what's going on. He couldn't get bank finance because it's a development, and it's these things, it's like there's no way out. Once you start something that big, there's no way out, and if the banks say they're not going to give you the money, or you're sitting there with a half-built development, you can't sell that. There's only one way out, and that's to continue to find a path forward. And it took 7 years. 7 years, Reece, this development. Put me behind, that and some to get back to square one. And I learned so much through that development. And it's, look at it like we should never have done it. It was a terrible idea. But to be honest, that set up the foundation of investing for me, and what not to do and what to never do and what to never advise clients to do. And I learned more through that 7 years than any degree could have taught me. I'll give you the tip.
At this stage, you're still playing football in Melbourne. You've obviously gone through this 7-year experience as well. What was the strategy to get out of that and go down the valuations route post-university?
Yeah.
What was the strategy?
Save as much as I possibly can, work as hard as I can. And there's no two ways about that. It was what is currently in play. You can't undo what had been done, but how we were going to get out of that, and the way we're going to get out of that is we needed to raise more funds. I needed to make more money to put in to strengthen Dad's position to be able to get funding to be able to finish the development. The only way we could get out was by finishing that. At the time I was training with Essendon, so the schedule was pretty hectic. You're training full time, essentially trying to be a professional footballer, and then I had a job at the university as the local deacon mailman, so I was delivering mail around university, and I was steam cleaning carpets for people's homes. So the only way I knew is just work really, really hard, but get the degree and then learn the fundamentals of property. And I don't think I had a mentor at the time that I was doing some work experience as well at a real estate agency, and the idea of getting really large commission checks at that time seemed like that was the direction I had to take, because we needed to get out of this debt and this dire situation we're in. So I thought, yeah, I can sell, pretty confident. I've been able to sell Dad on the fact that it was a good idea to do 6 townhouse developments in regional Victoria. Probably going to be able to sell a few houses in Melbourne. So I was doing work experience there. They'd offered me a job after my first day of work experience. I had to do 2 days of work experience. And I was out there knocking doors and getting listing opportunities for the agency in the northwest suburbs of Melbourne. But a mentor said, don't sell your soul like that. Go and learn the foundations of property. And the best way to do that is through valuations. It's not sexy, it's not fun, it's not pretty, but you learn the true value of property and what drives value, how to understand true value of property, what adds value, what loses value. But you're going to get paid next to nothing to do it, but you'll learn more in those 4 or 5 years than you will flogging houses or selling houses in different markets. So it's pretty hard, because the commission checks that were potentially going to come through were, my income would have been 4 or 5 times, maybe 6 times what I was going to earn as a valuer. But it was very good advice from a good mentor at the time to take a more conservative and educated process, which will set me up better long term. And it was the best decision I've ever made in my career to date.
What made the move to Western Australia then? So country. A lot of people wouldn't realise this. So we're based here in Perth. Obviously, we've got an office in Melbourne as well, but not a lot of people know that you're a country boy from Victoria. What made the move to Western Australia?
That was to pursue football. So throughout this period of property devastation and education, I was always trying to fulfil the dream of playing AFL. So it started at Essendon, couldn't get on the list there, and ended up at a VFL club, Frankston, and then West Coast and both Fremantle had shown a bit of interest. They wanted to see me come across to WA and play on some big grounds, and sort of flirted the idea that I could be a good fit. So straight away I packed the bags, get a job, and it was always speaking to over here what is waffle clubs is, whoever can get me a job in property I'll play with. And Subiaco got me a valuation job in the city at JLL, and made the move and committed 100% at the time. 2014 was the absolute peak of the Perth property market, so I was like, this is fantastic. Melbourne at the time was pretty slow, and you're in valuation, so it's probably easier valuing a slow market than it is in a bullish market, but it's not as exciting, right? Because there's a lot of ambitions in Perth. So you come to Perth in 2014, it's like they've just been on a bumper run where properties have gone up 3 to 4 times in the last decade. It was exciting, it was fun, and true to form, the next 6 years was probably the most depressed Perth market had ever witnessed. So you learn a lot during that period of where people got overexposed to what they shouldn't have bought. And it was an obvious link for me then when people are coming to me with development sites and I'm doing post-purchase valuations saying, this is a terrible deal, it's not going to stack up, you're going to lose money, to then starting to give advice to those developers and investors to say, hey, maybe bring me the property before you buy it and I'll give you my advice. So that's how the sort of transition made obvious sense from valuations to advisory, because I can actually help you make a better decision before you buy the property rather than value the property after you've purchased and said, hey, this is a really bad idea. Try the best you can to get out of it because you've overpaid.
Coming to WA, playing football, working at JLL, did your property investment journey start then, or were you just grinding at that point, trying to make AFL?
Yeah, obviously I still had this regional property that we were trying to finish this development. So any dollars that I had there were going into finishing that. Once I had a handle on that, I did kickstart the portfolio. And that was, again, in a metro regional, as we call it, in Geelong, and started to understand more of the foundations. And I could really see at the time that Perth was in a supply and demand imbalance. They oversupplied the market in 2014 by 110%. And being on the ground, it was very easy to see that Perth wasn't a great place to invest. So that sort of rent vesting began for me, and the borderless investing. But I was familiar with Geelong, probably more familiar with Geelong than I was Perth at the time, and I was fortunate to time that market extremely well. But obviously the research and education that I'd done up to that point was certainly far more informed than it certainly was for that regional development that we took on.
Do you think getting that valuations degree and actually doing the job for 4 or 5 years, that put you in good stead to move into more than the buyer's advocacy side of things?
Yeah, the advisory side, right? And that's what I said. That was the passion, because in valuations, it's not a super rewarding job. You don't really get a call to say, hey, thanks for that report you sent through. It's $100,000 under what I paid. It's not a fulfilling job, but I was doing a lot of development valuations as well, some commercial stuff. And then you start to form some relationships with these people and they start to appreciate the advice. So the natural progression for me was, let's help them before they make the mistake rather than after. And that's when I seen the opportunity that I didn't really know that you could charge a buyer's agency fee at the time. I didn't know there was advisory services. And that's when JLL asked me to head up that department for them, really create a department under their umbrella, which was advisory, and under that umbrella, a buyer's agency service. And took that with open hands and started to build out that division.
A lot of people will think when they're looking at property landlords with multiple properties, they think they're greedy and they've had it handed to them. What sort of sacrifices did you make? Sounds like modest income as a valuations degree. With a valuations company.
$50,000 I was getting paid.
$50,000. People wouldn't get out of bed for that.
First year was 45. I think I might have gone up to 50. Yeah.
So you're working for a valuation company. You got football on the side. So you're trying to balance a professional football career with valuations. What sort of sacrifice did you make to start getting these purchases in Geelong and some of these value add properties in Perth?
All the sacrifices that you need to make, and I think probably what people don't necessarily think, like, I know it's getting harder and harder to get in property, and it's always a story. It was hard then, right? It's like it wasn't easy to buy property. Banks didn't like me because I wasn't earning a lot. So it was, how can I increase my capacity? So when I was at uni, I had 4 jobs at any given time. I was playing footy, getting paid for that. I was a deacon mailman, getting paid for that. I was steaming people's carpets at night time, then going back to footy training, and then I'd work a bar shift at the local residential, the local university bar. That sacrifice. Every spare moment you have, you're either studying or working. I've never owned a credit card until this day. I still don't have a credit card. So I can't go and splurge on things that I actually don't need. And it's funny now that, very different times from when I was then starting my investment journey, I still, I've got the same discipline. I just don't see the need or the want to have a credit card to go and splurge. I've never owned a car, still don't own a car. It's like that discipline, I find it really hard. Even when people like that, how do you not own a car? I've literally rented a car the entire time because banks view the debt on a car extremely poorly, right? They when you're trying to get funding, first thing they look at is, have you got a HEX debt? So first thing I did was try to pay that down as quickly as I can. Do you have a car loan? Never had one because when I looked at that, it's going to hurt my serviceability. Do you have a credit card? Even if you've got a you use it once every blue moon. If it's got a 50K limit, they're going to take that off your serviceability. So all these things, I was like, how can I increase my serviceability and decrease my risk and exposure? And only few levers I could pull was work harder, make more money and spend less. So the sacrifices, I rent vested my entire 20s. I only bought my only place of residence and lived in that when I was 32. Like some people, that's probably pretty normal, but I had 9 properties in my portfolio before I actually bought my home because I was like, well, I don't need a nice house. And when I'm talking about room sharing or renting, I'm talking about living with like 5, 6, 7 people to keep my rent always under $100 a week. Because every dollar that I could save on rent, I could put that into paying off debt. So it's, lived in the worst houses you can possibly imagine. I've never owned a car and I don't own a credit card. And every dollar or penny I've saved, I've tried to put into my investment portfolio, which has gave me more options later on in life.
You've mentioned that with your actual investment portfolio at the moment. Is there any strategies that you implement on most of your acquisitions? So, one of the things we talk about quite a lot, I know you're very passionate about, mentioned it earlier today as well, is the value add strategy, especially on a character home. Is that something you employ on majority of your assets in your portfolio? Yeah,
like standing back now, looking at all the assets that I've accumulated over the years, they've all had an element of value add. So we call it VAS in our world, Reece, but it's just a value add strategy. And even that, that first investment, that development site that nearly sunk the ship, that was still value add, right? We took a parcel of land, that had one house and tried to turn it into 6, albeit timing was off, was the wrong market, was the wrong strategy for me at the time. The overarching principle of adding value, not just being reliant on the market, was in play. And then I've done a handful of retained subs where we retain the house at the front, subdivide the land and sell. Then that, as Trent Fleskins through his journey, his size of his developments have got bigger, so did mine. I've done large renovations, and bigger developments, haven't done apartments, but they've all had an element of value add, and that's just probably ingrained in me from a young kid. When you talk about growing up with Dad, I was pretty useless with a hammer in the hand, but seeing that strategy, and I like to be able to control, as you know, Rich, you work with me, I like to be able to control things and control my own fate. And yes, our data and research gives us the ability to predict markets, and we do a bloody good job of that, I think. Being in control of being able to create value in an asset has been really important to me.
What's your favourite property in your portfolio?
One that's probably, is really close to heart, and during that tough period, Reece, that I spoke about at the start, where I don't know if I did bankrupt Dad, but it would have been extremely close, and he's too proud to ever admit it. But there was a period there, probably at the time, when I couldn't afford to do it. Dad had built his retirement home next to his home in Murtoa, and this home was where I grew up, where my brother and sister, we all grew up together. Beautiful old, 1890 character home in Murtoa. And because of the situations we sort of explained earlier, there wasn't the ability for them to be able to move into this retirement home that they'd built, which was purpose-built for disability, and as they get older, they weren't going to be able to keep that and keep our family home. So this is sort of still early to mid sort of my investment career, where I didn't have the capacity or the ability to buy it, but there's absolutely no way I could let go of our family home. And really trying to help Mum and Dad out as well. I know they didn't want to let go of that home, so I did. We got a valuation on our family home. I think it came in at $300,000. So people say you can't afford to buy a home. There is still places, and albeit regional. So I paid them above market rate, which is exactly what you shouldn't do as an investor. I bought in a regional town, paid well above what the valuation was to keep that asset in our family home. And if I look at my portfolio, one thing I'll never sell is our home, and it's definitely my favourite asset. Certainly not what I'd advise clients to do, but for me, that is, you're allowed a portion of your portfolio to be a passion project, and that's for me. And it's now Airbnb'd. If anyone's staying in Murtoa, I think it's called the Murtoa Cottage. All the reviews are about Deb and Donk. Great hosts, because they're next door and they'll always pop over for a beer. So there's a little plug for the Airbnb in Murtoa.
Might have to put the link in the show notes for those that want to go stay at Murtoa. All right, let's talk through your services, I guess, you helping clients over the years. So Follio's obviously been running for just under 12 months, but you've had a previous business for 6-7 years. Is that right?
Yep. 2018.
And this is on the investment advisory side. And I think in this rise of buyers agents that are popping up left, right and centre at the moment, there's actually a strong stability there from a track record from yourself with your previous business, obviously with Follio. We've mentioned the valuations, but let's talk about numbers in you helping your clients. Over the last 6 years, you've helped more than 1,400 clients, I think, when we were starting to look at the book. 687 million, which is massive. So that's 687 million in uplift. Now, if we look at the big thing on that is roughly 526,000 average uplift per client, about 80% growth.
Per property, I think that is.
Correct. And you're also sitting on a 10.2% annual compounding growth rate for your clients.
I think for me, I think in the way of the buyer's agent race, everyone throws around figures. I've built $100 million portfolio. I've done this and done that. That's not us, right? But what makes me super proud is those individual case studies. My brother, I've used an example on the show where it's made a radical difference in changing their life because they could use that the average was $550,000 uplift, and he was banging on that to be able to pay off debt and have the definition of financial freedom. But to be outperform the market, so running at 10.2% compounding growth, when the Australian property market over the last sort of decades ran at about 8.2, I believe.
7.2.
So the average, when the Australian property markets ran at 7.2 and to be able to achieve a 10.2 compounding growth for our clients, that makes me super happy because I think our business, advising clients and buying and building out investment properties, we have an obligation to try and outperform the market. And I'm not going to say we absolutely always do that. I'm not guaranteeing that. But that makes me super proud because I used to get asked, 2018, 2019, why would I use a buyer's agent? Why should I listen to you? And, the reality is you can go build out your own portfolio, you can go buy your own property and hats off to you and good luck and I hope you do really, really well. But my job is to try and outperform you and what you can do through the years of experience and the data and the technology we have. That is my job and I can't guarantee it, but I'll do everything we can to do that. So to be able to sit back 6 years later and to have outperformed the market, almost 3% higher than the Australian property market makes me super proud because that's our job and that's our obligation. I do get annoyed now with all these buyers agents that, we had a recent guest that just said, I just buy properties, doesn't really matter where it is. It's, you guys do all the data, you do all the analytics, you just buy and hold. And I'm like, that goes against all the morals of what we do as a business, as a buyer's agent or an investment advisor. Our job is to try to outperform the market, to find those good deals. And that's what I'm passionate about. And seeing clients, and had a guest, Wayne Green, on last week, just an old bloke, really good fella on a pretty modest income. And what we've done for him over the last few years, it's life-changing. We've set him up for retirement. He wants to do more. And I'm like, Wayne, there's no more to do. Sit back, enjoy retirement because, mate, you've done the heavy lifting. That's the stuff that this is why we do what we do, Reece.
And it's something we haven't really spoken about as well. And we're very anti these people that are talking, 6-month uplifts. I've made 60K. It's all inflated. Valuations that are getting manipulated by those buyers agents that have probably only been around for 6 to 18 months. I think when you look at these core figures from a 6-year period, you can see a long-term compounding growth rate of over 10%. That's pretty impressive.
It is. And something we're super proud of, Reece, but like I said, it's not there to sit on what we've been able to achieve in the past. It's what can we do for those clients moving forward. But like I said, more importantly, for those that have, for me, what is financial freedom? And I'll speak a bit on the podcast. If you can own your home debt-free, and I'm talking about your dream home, your castle, after that, everything else is a bonus. And for a lot of these clients, a big part of the strategy has been getting that $500,000-$600,000 uplift, paying down debt, and being just happy with that. And that makes me super happy. You get a card in the mail saying thank you. We couldn't be happier. We're so glad we met you. Wayne was perfect. We caught up at a coffee shop in Leederville in 2018, 2009. He's like, mate, that was the cheapest coffee I ever got. Like those things that really make me happy when we sort of look at the journey and where we've got to thus far. Our job through this podcast is to try to do that for more. I've helped 1,400 clients in the last 6 years. That was the data. How can we help 10,000 clients in the next 6 years? And they're not going to be all clients of our business, and that's okay. But through the podcast, hopefully we can educate and inform on the mistakes, what not to do, and put my hand up, I've done that. But hopefully give some strategy and planning around what I think will be a more challenging 6 years ahead. I think we've had really good market conditions. That growth hasn't been Lachlan Delahunty as an investment advisor. That we've had some really good tailwinds with market conditions, which support those figures. The next 6 years isn't going to be as easy. I reckon we're going to get into more headwinds. We're in the midst of that at the moment. So strategy becomes more important than ever, and having a plan becomes more important than ever. So hopefully we can show, as personally and as a business and through this podcast, we can add more value to the listeners over the next 6 years than what we've been able to do for the previous, and that's my goal.
Before we wrap it up, Lachlan, what's next for Follio in 2026?
Help more people, Reece. That's why we started the podcast. When you think it's been 12 months since we've been doing this, we can't reach, I can't speak to everyone, but through this channel, we want to get better guests, we want to get better insights, we want to help more people, and to do so in a way that is always data focused. I think that's what I've learnt my entire way. It's like everyone's going to have an opinion. There's always going to be a headline, but the more we can invest in a business in our research division, through our indexes, our sentiment, the more informed we can be for our clients. And I think as a business, that's our obligation, to try and to continue to outperform the market and direct clients to make the right decisions.
You've been listening to the Follio Property Podcast.